This is not just a spike. It is an incident designed to test investor psychology. A micro cap that sits around a few $1 million in market value nearly triples in a single regular session, while volume explodes into tens of millions of shares. If your emotions do not move at all, that would be unusual. Should you chase it now? Are you already late? Is this a real change in value? Nasdaq listed Cemtrex with ticker CETX created exactly that scene. Intraday price traded in the $7 range, with gains pushing past 140%. The intraday high reached the upper $9 range, while the low dipped into the upper $4 range. Volume ran around the 90 million share range, yet shares outstanding were shown around the 700,000 share range. That combination forces one question. Was this a fundamental shift, or was it a liquidity event driven by a thin float and aggressive order flow? Let us make the key terms easy. Fundamentals are the company's basic condition. Are revenues growing? Is it profitable? Is cash actually coming in? Can it handle its debt? Flow is the money movement. Who is buying? Who is selling? How urgently and how thin the tradable supply is. In microcaps, fundamentals move slowly, but flow can reprice the stock in seconds. That is why a spike like this traps investors in a familiar dilemma. There is no clean answer, but it feels like you must decide immediately. Most investors are not anxious because they are greedy. They are anxious because uncertainty puts their capital at risk. Cemtrex describes itself as focused on security and industrial services. On the security side, it points to video monitoring, analytics, and recognition features, cameras, servers, and access control solutions. It also lists a wide set of end markets, including industrial and commercial facilities, corrections, hospitals, schools, and government agencies. Businesses like this are typically not one-time jackpot stories. They are contract-driven. You win deployments, you install, you operate, you maintain, and you upsell upgrades over time. In a normal trajectory, rising revenue should eventually reduce losses and transition into profit. But the headline numbers suggest that trajectory is not yet complete. Trailing revenue sits around the $70 million range, while trailing net income shows a loss around the $20 million range. Revenue exists, but profit does not. This is where the first mystery begins. Why does a company with real sales still bleed? The mechanics are simple. Revenue is the total sold value. To generate that revenue, you pay cost of goods, labor, sales expense, research and development, overhead, and interest. A large loss means expenses exceed the gross inflow. The hard part is not understanding the math. The hard part is knowing whether the spending is building future earnings or just keeping the lights on. Outsiders cannot see that clearly, so the market applies a discount of doubt. That discount can weigh on the price even when revenue grows. That doubt gets amplified by a structural event, a reverse split. On October 3rd, 2024, Cemtrex reported a 1-for-60 reverse split. A reverse split reduces share count and raises the per share price mechanically. It does not create intrinsic value by itself. In a typical healthy company, share price stays above listing thresholds because operations improve and investors trust the story. Reverse splits are more commonly used as a technical fix when a stock has traded too low and risks running into exchange minimum price rules. Investors rarely treat a reverse split as bullish. They treat it as a clue that pressure existed. The abnormal part is not the paperwork. The abnormal part is what it implies about the path that led there. That implication becomes sharper in 2025. On February 21st, 2025, there was reporting around a stockholders' equity deficiency notice. On June 9th, 2025, the company announced it had regained compliance with the Nasdaq stockholders' equity requirement. Stockholders' equity requirements are a way exchanges screen for minimum balance sheet strength. When that line wobbles, the risk of listing issues rises. When listing risk rises, capital becomes more expensive. Expensive capital can mean higher interest costs or potential dilution. Either way, it flows back into fundamentals. So this was not just a procedural blip. It was a reminder that the balance sheet had entered a tense zone. Then the company changed the stage. On August 25th, 2025, Cemtrex announced letters of intent for 2 strategic acquisitions in robotics and aerospace. A letter of intent is not a definitive agreement. It is an early step. In a standard acquisition process, you identify targets, negotiate initial terms, perform due diligence, sign a definitive agreement, and then close. Markets usually treat fundamentals as changed only after a definitive agreement and closing, and then after results show up in financial statements. But microcaps can move violently even on early stage announcements. When a fresh narrative appears, some money buys the story before the evidence arrives. That is the abnormality. It can signal a regime where narrative outruns numbers. Money followed quickly. On November 7, 2025, Cemtrex disclosed a promissory note with Streeterville Capital. Principal was in the $7 million range, and cash proceeds were also in the $7 million range. The stated purpose was to fund potential acquisitions. A promissory note is straightforward in concept. The company borrows and repays under set terms. In a more typical large cap acquisition, funding often comes from bank facilities or bonds that are more standardized. Smaller firms with limited credit and collateral sometimes rely on less standard structures. Those can be faster, but they can also be more expensive or more restrictive. This is where the second mystery forms. If the acquisition opportunity is truly strong, why does the financing look like something you take when options are narrow or time is tight? Either way, the burden eventually appears in the income statement and cash flow. On November 21st, 2025, the company announced a definitive agreement to acquire Invocon for an amount in the $7 million range, aiming to establish a new aerospace and defense segment after closing. The target is described as having aerospace and defense engineering capability, with references to work tied to Space Shuttle and International Space Station programs. This kind of narrative is magnetic. Aerospace and defense often implies high barriers, sticky customers, and long contract cycles. But markets usually re-rate on proof, not on phrasing. Closing completion, integration performance, and actual earnings contribution are what convert narrative into fundamentals. Until numbers confirm it, this remains possibility, not certainty. That is why it stays a mystery. The words are loud, but the financial evidence is still quiet. One more structural factor matters. On September 29, 2025, another reverse split was announced, 1 for 15. Repeated reverse splits can thin the tradable supply and increase volatility. In large caps, even surging volume is buffered by deep liquidity. In microcaps, concentrated attention can push price into moves that look irrational. That is why the intraday surge with outsized volume is not just excitement. It can also be a warning that flow is dominating fundamentals in the short run. And when flow dominates, investor emotion becomes the most dangerous risk factor. If you're still with me, I want your help. ValueStir is actively collecting tips from listeners on stocks and coins you are watching. Listed names, unlisted names, and even names rumored to be preparing for a listing are all welcome. If you have a ticker that feels misunderstood, a story that does not add up, a sudden spike that seems too fast, or a project in crypto that is drawing unusual attention, leave it in the comments. One solid tip can become the starting point for the next investigation and can help other investors avoid expensive mistakes. And to everyone who keeps this channel alive, thank you. Thank you for watching, subscribing, hitting like, leaving thoughtful comments, and sharing the video outside the platform. I do not take that support lightly. I will pay it back with tighter evidence, clearer explanations, and stronger narratives that respect your capital and your time. Now the conclusion. The price narrative driving Cemtrex right now is a combination of an aerospace and defense expansion story, acquisition-linked financing via a promissory note, and a thinner trading structure shaped by repeated reverse splits. The outlook is conditional. If the acquisition actually closes, integration is smooth, losses shrink, and cash flow improves, re-rating is possible. If integration drags, costs rise, or financing needs repeat, the surge can fade into a short-lived event. Finally, a practical framework using the visible price zones from that session. In the short term, the upper $4 area matters because it marked the intraday low zone. If that breaks, a deeper retracement becomes more likely. If the $7 area holds as a pivot, the upper $9 area can be retested. But in thin microcaps, breakouts can become quick wicks instead of trends, so scaling out and enforcing strict risk limits matters. In the medium term, watch whether volatility compresses between the upper $4 area and the $7 area, and whether acquisition updates turn into real financial impact. If price is pushed back toward the prior close area around the $3 range, treat that as a sign the narrative may be weakening and reduce exposure. In the long term, do not buy only because it looks cheap. Wait for evidence that losses are shrinking, cash flow is improving, and funding pressure is easing. That is the point where the story starts becoming numbers. The real mystery is not the chart. The real mystery is when and whether the story turns into financial proof. Until then, what investors need is not prophecy. It is a rule set strong enough to survive volatility. This was ValueStir.